everybody. My name is Sanjay Bonde, and I'm the CEO and Chairman of Trade Capital Corporation. We are based in the Silicon Valley, and I want to welcome you to this leadership series, the webinars that we host regularly to talk about global issues that impact business, finance, and also these days banking. We have an eminent panel of speakers today, and also you must be listening to us from different parts of the world. So if you are in your dinner time or you are in your morning time, I want to welcome everybody for the time you are sparing to be on this particular webinar. And I hope that this will add more value and be meaningful for you. So today we're going to talk about the flight to safety in the financial assets. There has been a lot of risk that has emerged over the last couple of months, notably in the banking sector, as well as the interest rates, the inflation, the mortgages, etc., that have now become more expensive. There is a situation of concern, not only individually, professionally, but also amongst corporates. And we have an eminent panel here to discuss this at length. And I'm very pleased to welcome, first of all, Michael Connor from Truist. Michael, if you may want to just introduce yourselves to the guest, and I would then go to the other panelists.
Sure, Sanjay, thank you very much. I am Mike Connor from Truist Bank. I'm a managing director in our financial risk management group, and I work with corporate and investment banking clients providing interest rate and commodity hedging solutions.
Thank you very much for being with us, Michael. We also have with us TCC's chief strategist on the technology side, Eric. Eric Almendinger, would you please introduce yourself?
Hi, good morning, good afternoon, everyone. My name is Eric Almendinger. I've been advising TCC on the technology side. I've been in banking at Credit Suisse and have been the founding member of a number of different technology platforms, from supply chain to corporate bond trading.
Thank you for being with us, Eric. Then we also have Vish Patel. He is a strategist on the emerging markets, has worked previously with BlackRock. Vish, if you can introduce yourself as well. Thank you.
Yes, thank you, Sanjay. Hello, good morning, everyone. Good afternoon, wherever you are. My name is Vish Patel. As a background, I have 20 years of experience in credit, both US and emerging market. I worked at Franklin Templeton, BlackRock, and most recently at Loom Sales.
Thank you. We have a really exciting group of panelists. I want to remind everybody that we have a Q&A session at the end of this seminar, of the webinar, which will be around 8:35 a.m. We would kick the Q&A session. So if you have any questions, you may please write it into the Q&A box, and that's the chat box on your screen. This particular webinar is also being recorded for future use and is also live on YouTube. So people who are watching it on YouTube, I would like to welcome you. Let's get straight to the agenda. Right now, the biggest hot potato that we have on the economic zone is the debt ceiling and the impasse that is going on in Washington about whether there would be any resolution or whether there would be a default on the banking side. And this is a very critical subject. It is unprecedented. It has never occurred before, except once, I think in 1979, if I remember correctly, Michael. I think he may remember this, but this is unprecedented. And given where we are, it is a major cause of concern, especially as the banking industry is going through a lot of upheaval. So, Michael, if you can comment on that and take it up, that would be excellent.
Sure, I'll do that. Could the administrator please pull up the slide and go to slide number 2? I think as we talk about interest rate risk, it is important right now, front and center. The debt ceiling debate is the biggest driver of the rates market right now. As many are aware, the X date, which is the date at which the U.S. government would not be able to cover its financial obligations, may be as soon as June 1st. And the Treasury bill market, investors in the Treasury bill market, are watching this. And what we see on this particular chart is the difference in yields between the Treasury bill yielding, or the Treasury bill yield that expires on June 6th versus the one that expires on May 30th. So there's, as of a couple of days ago, that spread had blown out to over 200 basis points. So 200 basis points, an additional yield pickup to hold a Treasury security 1 week longer past the X date than May 30th. This spread has been declining. It's currently 150 basis points. We have seen some positive movement on the debt ceiling debate. Kevin McCarthy yesterday said that I can now see where a deal may come together. That's very positive. A U.S. government default would have long-term catastrophic consequences, and it's important that Congress resolves this particular issue. It appears that we are moving in the right direction, and we need to get this wrapped up over the next few days.
This is, as you said, this is a matter of heightened concern, and it may not survive more than 2 or 3 weeks as a issue. It would get resolved one way or the other, hopefully so quickly. But the later it gets resolved, the more uncertainty and the more turbulence it creates in the minds of financial analysts, bankers, and also people who are dealing with capital. Vish, any quick comments from you? You've seen this from your view. If you can give us any ideas of how you think about it.
Sure. Thank you, Sanjay. Yeah, so I just build on the thought about uncertainty. If you're seeing 200 basis point spike in the funding for the Treasury, which is essentially the risk-free rate off of which everything is priced, that same uncertainty goes along for the entire spread, credit spreads as well. And so you're beginning to see less and less new issuance in the market. You're beginning to see banks and other investors pull back on the credit allocation that they are doing. And this uncertainty is already having an impact on the overall, what I would say, credit creation for US corporations across both public and private.
Yes, I think that, there is that we can almost see and sense that this is a situation which is not one of the most exciting situations in. But hopefully there is some respite around the corner with the government resolving this and coming together and getting it resolved as quickly as possible. We had to touch upon this because it is front and center for everybody in the banking and finance world to think about. So thank you for your comments here, both Mike as well as Vish. Michael, if you look at where we are as an economy, interest rates have rapidly risen. I don't think we have seen those in the last as prominently in the decade. We've been used to almost free money for some time, and inflation is high. It has reduced a little bit, but we don't know what trajectory it might take in the future. Unemployment is at its lowest. There are lots of these, we call it counter-cyclical or not really unidirectional phenomena. And so it's a very volatile world together with no clear direction. If you can throw some light on that, it would be excellent for the audience.
Sure, thank you. Why don't I provide just a little bit of background on the rates market as we talk about this discussion, spend just a few minutes going through a couple of slides. If the administrator could go to slide 3, please. We'll flip through a few here. So this particular chart shows U.S. Treasury yields, specifically the 5-year Treasury yield, going back 5 years. So we see the decline in rates during the pandemic and the sharp increase in rates, as Sanjay mentioned, over the past couple of years. And if you look at where we've traded over the past 6 months, the market has been veering between fear of inflation, which leads towards higher rates. And in October of last year, the 5-year Treasury yield hit the highest level in 15 years. But it's also been quite volatile. It's moved lower. When rates are lower, we have fear of recession. And we're a little closer to that right now than the fears of inflation. Move to the next slide, please. Another way to think about the rates curve is to look at the forward curve for SOFR. So the dark purple line that we're showing here, that it is the current SOFR curve, has moved significantly from where it was on March 8th. That was prior to the Silicon Valley Bank collapse. And so we've seen a concern about risk that has led towards lower rates. It appears at this point, as regional bank stocks start to recover, the past 10 days have been relatively friendly for the regional bank index. I think the Fed and other regulators believe this situation can be contained, and they're going to be focused primarily on their inflation fight. And as Sanjay mentioned, inflation has come down. It's still elevated, and we have a very strong labor market. So flipping to the next slide, another way to look at this is the same SOFR forward curve. These dots represent the Federal Reserve's consensus opinion, the median forecast for where the Fed funds rate will be at the end of 2023, 24, 25, and longer term. And as you can see here, there's a disconnect between what the Fed members are projecting. They're projecting higher, shorter term rates for longer than what the market is currently expecting. The market is expecting interest rate cuts by the end of the year, and that's not the signal that we're getting from the Fed. And so why is that? Well, the Fed is very concerned about inflation. And looking at the next slide, this particular chart shows the Fed's preferred inflation metric, which is called the Personal Consumption Expenditures Index. It hit 7% in June of last year. That is well above the Fed's 2% inflation target. It has come down to 4.2%, so it has come down meaningfully, but there's still a lot of wood to chop before the Fed brings inflation all the way down to 2%. And keep in mind, the Fed has raised short-term rates and within 14 months, 500 basis points. So they have thrown, to use an example, a lot of water on the inflation fire, and it's still unacceptably high. So I'd like to conclude by just talking about a couple of structural changes that the Fed is grappling with in the labor market as well as with globalization that is keeping inflation higher. So looking at the next slide, here in the U.S., we've heard a lot of anecdotal evidence about labor shortages and a very tight labor market. I think this is a really interesting slide because the dark line in the left-hand scale shows U.S. births per year. And what this tells us is that the peak year for baby boom births was 1957 and 1960. That's later than most people think it is. Most people tend to think baby boom peak births were in the late 1940s. It was actually 57 to 60. That's 63 to 66 years ago. So you have a lot of the baby boom generation in the U.S. who are entering their retirement age. At the same time, looking at the right-hand scale, the lighter shade purple, the labor force participation rate in the U.S. has been declining for 20 years. So you have a combination of accelerated retirements and lower labor force participation, which adds up to a tight labor market and higher wage inflation. Looking at the next slide, at the same time, COVID reinforced for many American businesses the importance of shoring up their supply chains. And so we're seeing much more manufacturing and investment in the U.S. than we saw, say, 10 years ago. Intel, as you may be aware, is building a semiconductor foundry in Ohio. I doubt they would have built that in Ohio 10 years ago. It's much more expensive to build a foundry in Ohio than it is in Taiwan, but there's a need to bring supply chains, to shore up supply chains, bring manufacturing closer to home. And so last year, according to the Reshoring Initiative, about 350,000 jobs were created in the U.S. From this phenomenon. And I'll conclude with the very last slide, taking a broader perspective. This chart, there's a lot of information here, but this chart shows 10-year Treasury yields going back 35 years. You can see generally yields have been coming down at the same time that inflation has been coming down. Two of the biggest factors in lower inflation during this time period have been maximum globalization and abundant labor. So if you go back to the beginning of this period, you had a lot of free trade agreements. China joined the World Trade Organization. The euro launched. All this was positive for globalization and increased the global labor supply. If you look over the past 5 to 7 years, China's working age has peaked. We've had tariffs that are relatively, they've come back relatively recently in the U.S. economy. We've had Brexit, and with COVID, as I just mentioned, we've had onshoring. So we've moved from a period of abundant globalization to deglobalization, abundant labor to tighter labor. And as a result, I think that these are two factors which will keep inflation higher for longer. I think the period of rates from 2008 to 2022 historically will be seen as more of an anomaly. I don't think we're going back to the crazy high rate levels of the late 1970s or early 80s when mortgage rates were 12 or 13%. But I do think we're moving into an era where rates will be higher than what we've been accustomed to over the past decade. And with that, Sanjay, I'll turn the call back over to you.
one cannot but think that this is, if not a recession, a very stagflationary era that we have entered. And we don't know how long we'll be in here. Obviously, the inflation is going to stick around for a little bit longer. Interest rates may not come down. And the unemployment rates being higher may continue to keep that inflation higher and interest rates higher. But yet, at the other end, corporate demand and corporate profitability is likely to suffer. It already is underway. We've seen that many of the companies are giving earnings updates which are lower and downplaying their earnings. And we've seen much of that happening over the last, just say, a month or two. In the context of that, in this risk, there would be certain things that corporations would be better off doing. And we've seen that despite all the interest rates going up, corporates are still loading up on debt. The amount of debt on corporate balance sheets is growing. What that tells us is that the corporates, despite higher rates, are loading up and bringing in more debt capital onto their balance sheets. And this could be a risky maneuver. There are also other assets on the balance sheets of corporates that may make it difficult for CFOs and CEOs to essentially prioritize where they can get their returns on their capital deployed. I remember situations in 1990s, but not too many people may have been there. But the OPEC crisis and the one after that, the dot-com, every of those first recessions were very different. We've seen that the 2008, 9, 10 situation, but one common theme across the board was the corporates immediately tightened their belt. All the fancy projects went away, and you had to figure out where you would add more value to your shareholders. We don't see that as aggressively being taken up. Any quick comment on that, Michael, from your end in terms of what should be a good strategy for corporates? And then we will turn it over to Vish to talk more about how he sees the manufacturing sector.
Thank you, Sanjay. I think it's a broad question, an interesting question. I think if I were leading a company in this uncertain environment, I would be laser focused on improving operational efficiency and just focusing on the things that I can control and try to adjust to external factors that I can't control.
That's very, very, very succinctly put. Vish, let's move on to you. You've seen all the different sort of factors and criteria that impact corporates, and you've been at the front and center for emerging markets as well, where the risk-reward relationships has been a bit different. Can you talk about what's going on in the corporate world and your understanding of where the situation might evolve?
Sure. Yeah. Thank you, Sanjay. Can the administrator put on this slide on inventory? Let me just take a second here to explain it. The white line is the US manufacturing PMI, and the blue line is the inventories held by the business. So and this slide goes back to 2008. And as Mike alluded to in his commentary, that you're seeing a regime change or a structural change. And through the cycle, inventories have been very tightly correlated with the manufacturing cycle. Could the administrator go to the next slide, please? So here, and this is the regime change that I'm talking about. Post-pandemic, you're beginning to see a dislocation between inventories and the US PMIs because corporations had a difficult time in acquiring inventories. And also, what we are going through is a deglobalization or friendshoring that by definition means more disruption in supply chains, and businesses have to hold a little more inventory. If you look back to the pre-pandemic world, which was very much a just-in-time world, what does that mean? Just-in-time also meant a very efficient balance sheet, a very efficient working capital as well. And now you're in an era where corporations have to address the working capital efficiencies, which they never had to think through during the globalization cycle.
I think we are familiar with what happened during the pandemic and essentially supply chain issues that caused inventory to be in short supply. The inventory buildups were not consistent, and there was misalignment of the entire procurement cycle, and that has led to certain phenomena on corporate balance sheets that corporates will be reeling under for a reasonably good period of time. And it's not easy to take off such, what do you call, the outcome of such a persistent purchasing environment very quickly. It's not going to happen overnight. And we don't see supply chain issues coming to a standstill or coming or disappearing over the next couple of years. In that context, Eric, I'd like to turn to you and look at how the banks have performed and see where the possibilities for the emergence of a new reality working together with fintechs. Can you comment on how you see this relationship and also the flight to safety, which is underway, given the risk in the banking environment? Many of the banking participants would like to participate on investment grade assets and investment grade risk. And there is that disconnect between the haves and the have-nots, or the people who want capital and the people who actually get it. Any comments from your end?
Sure, Sanjay, and thanks, Vish and Mike, for framing that so well for me. So, look, financial institutions are clearly becoming more risk adverse, throughout the turmoil that we've seen lately with the regional banks. In addition to that, as you guys have just discussed, there are so many different economic indicators that are pointing towards challenging economic times, right? So what do banks do? They can either hold back capital, or they can do something that is a little safer. They can find investment grade clients and they can lend to them, but still they're pulling back slowly but surely, right? So what can fintechs do? Fintechs can kind of provide structures which provide a flight to safety, right? So it's specifically with regard to inventory financing, you can set up bankruptcy remote structures where LTVs are capped, where they're secured by the underlying goods, where you have a very secure loan, standard resaleable inventory items in the unlikely case of default, right? So besides the structures that you can set up in the underlying collateral, fintechs can work with clients, and it's specifically institutional grade clients, and transact with shorter terms, and again with security on the inventory, which further mitigates all the risks.
Yeah, the last word that you used was risk. And I think nobody wants to see a 2008, 9, 10 situation ever again. And I think what you just relayed, Eric, makes a lot of interesting thought for how fintechs and banks can collaborate. And this is a subject that's not new. I think we've been talking about fintech and banking collaboration for a long time. But given the situation where we are at heightened interest rates, heightened risk, the deflationary situation in the market, would the banks actually be more innovative? Would their risk appetite to work with creative and not creative, but more well-governed, innovative solutions be on the rise, or will it be curtailed? One has to see. And I think I'm going to take a leaf from the automotive world, and I think everybody knows this, that the electric vehicle industry did not bloom in Detroit. It came up in the Silicon Valley. You have several companies, whether you talk about the Teslas of the world or the Lucids, as well as Rivians and many others, Monarch, for example, as a tractor company. All of those they came about in the Silicon Valley, which had nothing to do with hardware. And the reason I bring this up is that there was a confluence of factors that came together to create another outcome. It was about good materials, or software or hardware, and coming together. They were not the ingredients of the past. I think there is a ability for us in the banking, fintech, the world outside, such as insurance, the logistics carriers who allow us the ability to track and trace materials, be making sure that risk could be managed much more effectively and in real time. These kind of solutions coming together can deliver a much more robust, well-governed outcome. And we do agree with you on that. And hopefully we at TCC are working on that. There are various fintechs. We're not the only one, but certainly there would be an opportunity for the banking world and the fintechs to come together at this particular point in time. And not only fintechs, but I would say the third 3PL logistics companies, we talked about insurance companies, but also the risk and rating agencies and everybody coming together. There is this era of heightened risk, and perhaps mitigation is of order. But nothing beats where the corporate vision is to be more agile and more mindful of where capital is deployed. I want to go back to Mike's words. Mike just said, if I was the CEO of a company, I would be very mindful of operational efficiency first before I start taking in capital or looking at investing into ventures which have either high risk or may not have returns that could be reliably expected. So let's just take this. If you were to be appointed, let's just say a CEO, tomorrow, and you got to be the CEO of Ford Motor Company, what would you, as the CEO of Ford Motor Company, do?
Well, that's an interesting question. As make believe, I would embrace the change underway with vehicles, and I would refine battery technology, and I would leverage 100+ years of experience with my company in building cars and incorporating the battery technology into the cars, because that appears to be the future for the company.
So that's a lot of internal deliberations and a lot of internal work that you would do. I didn't hear you say mergers, acquisitions, trying to do cross-border deals, etc. And I think that talks about conservatism in approach, but it was well put. Let's ask the similar questions to the other panelists. So we have why don't we go, Eric? Eric, if you were to be made the CEO of Home Depot, how would you run a company as big and as diverse as that?
Yeah, when I think of Home Depot, I think of meandering through aisles and endless amounts of supply. So I think right away of negotiating favorable terms with suppliers, bulk discounts, extended payment terms, managing inventory to optimize my holding costs, right? That's kind of how I would handle things given this point in time.
Again, very similar to what Mike mentioned. You're talking about optimization of inventories, optimization of supply relationships, and trying to figure out where your demand and supply matches are or mismatches are, and trying to be consistent with that. I'm just throwing these names at you and trying to ask you, your reactions in a split second as a CEO of companies that big. Let's do the same thing for Vish here. Vish, if you got to a big finance company and were to be made a CEO of a financial behemoth, let's just say somebody in the PE world, pick a name like a Carlyle, what do you think you would do?
Sure. No, thank you. That's a very broad question, but let's think about this way. What's the global trend is basically reshoring, right? And where can investors or finance companies play a role? Traditionally, they've always played a role in the capital structure by providing long-term debt and long-term equity. However, as companies come back on shore, as supply chains get retooled, investment companies can also partner with TCCs of the world or other fintechs to provide a more efficient supply chain solution. And what capital companies can do is provide the funding and creative funding on that end as well. So enabling the reshoring to be much quicker, bringing capital efficiency and making it more optimal, and thereby bringing the overall cost of capital down as well. And in turn, improving operational efficiency and reducing uncertainty as well for the business cycle.
Thanks, Vish. I think you talk about the cost of capital being higher, and it is palpably higher. I think for those who have mortgages are already feeling it. Some of the corporates have money that has been raised, perhaps at lower rates, and it is long-term money or mid-term money that may run out its cycle and may have to force these corporates to lend at higher rates. We see a very interesting situation where the cost of capital is going to be on the higher side. Inflation is going to have a drag on margins. Demand is a little bit subdued, or who will be subdued over the next 24 to 36 months. And given that, there are also no guarantees in terms of whether the Fed would start any immediate decline of its pressure on taking capital out of the system. So capital availability is going to be under pressure. all of those facts make it very important for leaders of the companies that we all work with and our clients to be mindful. I think that is the message we are hearing very loud and clear from you, and I cannot more agree with that. Talking about manufacturing companies, I think there has been a big talk about the loss of employment in the tech sector, and I was looking at Elon Musk. His interview from yesterday, and he called it the laptop economy, I think, or but I think there's a lot of middle America that is still in the manufacturing sector, that is in the transportation sector, and I think there is robust demand there, but especially for labor, and I think that economy will need support. And so thank you for bringing these points up. And let's open it up to some questions from the panelists. I think we see one here, which I would like to pose. Is the current environment unfavorable for small and medium-sized banks, and how can they leverage position with platforms like TCC? That's I think, a TCC type of a question. Is it more unfavorable for small and medium banks? Can you comment on that part of the question here, Mike? What's the future of the regional banks and the small and medium banks in terms of their ability to?
Good question. I'm probably not the right expert to have a definitive view here. I think that we have seen regional bank stock prices come under pressure. We have seen a few regional banks either go out of business or be absorbed by other banks. I think there has been some stress. I would note, though, that if you look at the regional bank stock index over the past 10 days, it has recovered and stabilized. So I think this is I would characterize this more as a situation that the Fed and other regulators believe can be managed. That's my own personal view. Think of all the shocks to the system over the past 20 years, 9/11, the great financial crisis, the European debt crisis, COVID, Brexit, all these stressors impacting banks. I think the industry is very resilient. Again, my view.
Yes. Well, thank you for that. We certainly have seen the concern levels decrease a little bit over the last month or two. They were very heightened earlier part of the first quarter. As we saw, there was flight of capital from regional banks into the larger banks. We saw that stabilized a little bit, and we also seen that the Fed might actually come up with some more norms about capital adequacy and also about capital resiliency of banks and support it as well. So hopefully, let's just see what comes out of. We'll be closely watching the Fed's actions with regard to small and medium-sized banks. Then there was a question about how can TCC and smaller banks work together, and can they leverage the platform of TCC? I'll pose this question maybe first to Vish. Vish, given the limitations of smaller size banks and of course also their current situation, how do you see the smaller banks participating more vigorously with the fintech world?
Sure, thank you, Sanjay. So if you think about it, right, smaller banks tend to be more regional, which means they tend to have customers in their own geographic area. As you bring manufacturing back onshore or nearshoring, this is where the smaller banks can probably help their clients with more financial services as well, and thereby use fintechs like TCC to provide a full suite of solutions and expand their product base as well, or services to their regional clients. Regional banks servicing regional manufacturers or small or medium-sized businesses, using fintechs like TCC to provide a broader suite of services that were not previously accessible to them. So partnering with fintechs like ours gives regional banks a leverage and allows them to also compete with the other national money centers as well.
That you bring in a good point. I think it allows the regional banks or even smaller mid-sized banks to be able to get to the quality of credit that they would not have otherwise had access to through these platforms. And I think platforms have democratized the access to good quality credit and to investment grade credit. just by the nature of their operations. So I think that's a really good point. And then I would want to just add, it also depends on the, again, the innovative content of regional banks. Not every one of them is as innovative as the other, and also the ability for them to manage risks more proactively, the ability for them to understand client expectations, etc., and provide a product solution. So those would be the asks on the smaller banks, so that they can work vigorously on this front. There's another question about loan portfolios are getting limited. Are banks collaborating with other banks and referring mezz debt equity platforms together with TCC? I think this question is about, would banks and PE funds, etc., work together to deliver different outcomes for clients now at this stage? Just because I think that the question in itself refers to sub-investment grade risk. What do you do with that portfolio of companies that do not fit the banking criteria? How do we support them going forward? Vish, if you can again touch upon that.
Sure. First, I would like to acknowledge it's a very insightful question. And if you think about what the question is can platforms like TCC bring these disjointed capital providers together and provide a full suite of solutions where bankers and PE come together on our platform and provide a full suite where you can do inventory financing and you can do long-term capital structure financing as well. That is a real possibility. And fintechs like ours can provide those capabilities and bringing all these types of investors on the same platform.
Thank you. I think we talked about several things. We talked about on this call what is going on in the world of Washington, if you will, with the debt crisis. We did touch upon the several other indicators. Thank you, Mike, for bringing all of those to bear and to sharing those with our audience. We will be sharing your slides with the audience, both your slides as well as Vish's slides, so that they be takeaway for them. But thank you for enlightening our team here. Vish, thank you for bringing out the disconnect in the manufacturing and inventory, and also the operational benefits that we need to bring to bear. And this is a call to action for corporate CEOs. You played your roles very well. Might I even say that? Eric, I think you talked about how to create structures, how to govern these structures so that we can be a little bit more agile, but manage the risk. TCC, we talked about that in that light, but also several other platforms that can do that. And I would only conclude by saying, yes, I think now is the time for leaders to look at operational metrics, but also we talk about inventory. And too much of that is not good. It clogs assets and balance sheets. But I would take this opportunity to encourage everybody on this call to look at other form of inventory and perhaps build more on that. And that is the inventory of compassion, the inventory of respect, the inventory of dignity, the inventory of how we support each other during difficult times. I think as not only as a country, but as people, there is an opportunity for us to dig deep within us and figure out the inventory of character and see if we can build on that. Not all inventory is bad. And so I would take this opportunity to encourage everybody to take a moment back, look at your lives, and see if we can empower ourselves with higher inventories. Not on the corporate side, though. Thank you, everybody. Appreciate your time and have a beautiful Friday and a good weekend. Bye-bye.